Hello everyone, welcome to the channel. My name is Fuller Kamara. Today we're in chapter 35, the profit and loss and balance sheet report. The two most common important reports you and your clients need to be able to use are the profit and loss and the balance sheet. Running a comparative profit and loss report also allows clients to compare their business's current past performance with that of a different period. This can reveal cash flow trends in spending and earnings from the business. To run a comparative report, once we've run the profit and loss, we can then select compare to another period, let's say to the previous year. So we can say the dollar change and the percentage change as well. If we check this, it will show as a percentage of the. So once we finish, we can click out of it, click run. So you see now, after we've run this, you can see now the column for prior period and the change in dollars. Okay, so that's how to run a comparative report. We can also change this to percentage of rows. So if we run this, so now you see you can get the percentage of rows, that is 100% of this amount. So you see that's how to run a comparative report. So unfortunately we don't have data in the previous year, that's why you are seeing 100. Okay, so now analyzing the profit and loss report, you can help the client understand the profit and loss report, how it can help them with financial planning. When analyzing the profit or loss, look for discrepancies or things that look out of place and make a review of the total income, these numbers, to see the composition of the total income. What is the total expenses? And you can drill down into the detail by just clicking on these numbers. So once you click on those numbers, you can go into the detail to see the breakdown. Okay, you can also look at the net income. You can review the net income to see maybe if we have the prior year numbers, you can look at this number compared to the prior year to see how the company's bottom line has changed year over year. You can also compare the sales, let's say the revenue, to the gross profit. You can also look at the uncategorized income and expenses. So if you see any uncategorized income or expense, you have to try to understand why those are not being categorized, to make sure they are in the proper category. Okay, then also we look at, we compare the trend. Like in audit, we have what is called a threshold. So we can set a threshold. Maybe we can say any variance greater than 1,000 and maybe the percentage change greater than 10% be investigated. So if we look at the fluctuations, if we see a variance that is greater than 1,000, if that was our threshold, or maybe 2 million, if that was our threshold, then the percentage change also, if it is greater than 10%, then we can investigate to know what caused that change. So once we know the reason, then we can discuss with the client, or maybe we can ask the client to understand maybe there is a change in the business strategy. Let's say, for example, for account receivable, if we see there is a significant increase in the account receivable, we might want to understand why, because the risk of bad debt might increase. Then also we can look at the sales. If there is an increase in sales and there is a proportionate increase in account receivable, there is a possibility also that the risk of bad debt will increase, because it could mean that most of the sales is on credit, and we might want to review the credit policy or the client's credit policy to make sure that they are in compliance. The risk of bad debt is low. So those are some of the scenarios we might look into. Then also we can look at the advertising cost. If there is any advertising cost, we can divide it by the revenue to see the amount, the percentage of advertising to the revenue. So if we see a high percentage of advertising cost compared to the revenue, it means the return on advertising is very low in that case. So let's say we see 10% of advertising. Yeah, you can set up a threshold based on your understanding of the client. But yeah, the moment we started seeing seeing the advertising is going up where revenue is not increasing, meaning there is low return on advertising. So some companies might have like a low percentage, maybe 3%. Yes. So it all depends on the company's policy. Then now we can go back to analyze the balance sheet. So for us to analyze the balance sheet, we can look at each bank account and also credit card account. We want to make sure that this 1,201 agree to our reconciliation, to the register. That is, we tie it to the subsidiary ledger. Okay, we tie this 1,201. So let's say this is for this year. So let's do a comparison. Previous year percentage of row. Let's run it. Now let's go back. Let's look at the check register. Let's say if we go to the chart of account, so this is the check register. If we view the register, you can see that this is the balance. So this balance ties back to our balance sheet amount. So meaning we're good. Okay, so let's go back balance sheet. This balance ties back to the check register. We run the report so you can see the percentage change. Unfortunately, we don't have the prior year. Then also we can look at the account receivable, the AR, to see if this ties back to the sub ledger. Okay, or we can also drill down into the AR to see the detail. Okay, you can see the breakdown of the account receivable. This is the transaction report. So if we go back, you can also compare this to the AR aging or the AR aging detail. So let's say that we currently have 5281. So if we go to report, account receivable aging summary, so let's say this year, so you see 528152. So yeah, the number ties. So this is the kind of comparison that we need to do. Then we also have to review the new assets purchase, because if the company buy new assets, we want to make sure that those assets have been recorded or have been placed in service. So if they've placed those assets in service, if they are depreciable assets, to determine the depreciation charge and the accumulated depreciation. So that's the reason why we need to review any new asset that the client purchased to see if they have accounted for all those assets and also the depreciation. Then the prepaid, we need to confirm that they were accurately categorized, because prepaid means we pay for a service that we've never used. We want to make sure that information is accurate. For loans account, we want to make sure that the loans account have been reconciled to the ending balance. So let's say we have a note here. We want to make sure this note reconciled to the loan account. Then the owner transactions, we want to make sure that if the owner make any capital contribution or distribution, we want to reconcile that back to the owner's account. We want to make sure the opening equity balance ties to the prior year equity. Then we also want to make sure the net income ties to the profit and loss. So let's go, if we can see 1642, let's go to the profit and loss to see what was the net income. So currently we have 1642. So if you can see the 1642 here, so this net income here is the number that we're seeing in the balance sheet currently. So yeah, we want to make sure this number ties. See 1642, and there was no retained earnings in the current year. So normally retained earnings is the accumulation both the net income and also the distribution there minus any. So what's left is the retained earnings. This is just high level. We don't go into detail like calculating ratios to diagnose any inconsistency. We don't go into that detail. So this is just a high level, basic understanding for QuickBooks. That's the end of chapter 35. Thank you for watching. Please don't forget to subscribe, like if you like the video. See you in the next video.